Limited liability companies meld many of the characteristics of a partnership with those of a traditional corporate legal entity, and the process of registering the business as a company is known as incorporation. Many businesses choose to operate as private limited companies, and unlike sole traders or partnerships, a limited company is its own separate legal entity. Private limited companies limits owner liability to their shares and limits the number of shareholders to 50. A private limited company can be used as a structure for any type of business, for example, a plumber, hairdresser, photographer, law firm, dental practice, accountant, or restaurant. Limited liability companies are distinct legal entities from business ownership, thus protecting owners from personal liability for the debts and damages of the firm. Limited liability means that the company is a separate legal entity to its owner, or owners, and the company as an individual can own assets, equipment, or offices, and is responsible for its own financial losses and debts. A private limited company can be owned by an individual, a group of individuals, or another corporate entity, and the shareholders of the business are restricted from publicly trading shares. For example, in the event of selling shares, shareholders of private limited companies cannot publicize the sale of their shares and have to sell the shares privately by inviting people to buy their shares. Every private limited company is owned by shareholders who invest in the business when they buy shares. In case the company fails or goes bankrupt, shareholders cannot lose more money than they initially invested in the company. For example, they will not lose their personal assets, like their house, if the company fails, and this is known as limited liability. Meaning, the company is a separate entity from its shareholders, and it is only responsible for the money that it owes. The advantages of private limited companies include: starting with the big one, limited liability for the shareholders, as shareholders are only liable for the company's debt to the extent of their invested capital. It's also easier for private limited companies to raise capital, as extra capital can be obtained by issuing more shares. Private limited companies have separate legal entity to their owners, meaning the business can take out loans under the business name, without impacting on the shareholders' debt. The business's existence is not threatened by death or removal of one of the directors or shareholders, meaning a private limited company can continue its existence regardless of changes in ownership. However, there are some disadvantages of private limited companies, and they include: higher degree of complexity in establishing the business as a private limited company, especially when compared with sole traders or partnerships, as private limited companies must comply with additional legal requirements, such as holding annual general meetings and filing annual returns. Private limited companies have higher establishment costs, as setting up and running a private limited company can be more expensive than other forms of business due to legal and accounting costs. Higher degree of government control and reporting requirements, as private limited companies are subject to greater regulation, such as auditing requirements, than other forms of business. Additional compliance costs, as private limited companies are subject to more administrative requirements than other forms of business, such as maintaining accurate financial records and filing annual reports. More difficult to transfer ownership, as shares in private limited companies cannot be freely traded on the stock exchange, making it more difficult to transfer ownership or even find buyers for the shares. Overall, limited liability is important for companies, as it helps them raise money, and with limited liability, investors only risk losing the money they have invested in shares, and there are many more privately held companies than public companies in existence. A private limited company are easily recognized as it includes the words proprietary limited. This classification works to place some restrictions on how this type of company operates, such as allowing for a maximum of 50 shareholders, and the shares can only be sold privately, as such not open to public trade. While extremely large businesses tend to become publicly traded at some point to access capital markets and gain liquidity, there are many well-known private companies, such as Deloitte, KPMG, Ernst & Young, IKEA, Lego, and Rolex to name a few. It's important to weigh these advantages and disadvantages before deciding whether to start a business as a private limited company. It's also a good idea to seek professional advice from an accountant or solicitor before making any final decisions. Thanks for watching. If you have any further questions about private limited companies, please don't hesitate to reach out to us in the comments below.